Good evening. It's 6:30. Let's wait a couple of minutes for more students to come. Okay, let's get started. So today we're gonna try to build a model for valuation of a real company, and we'll discuss all issues that we'll see with its financial reports, with its forecast, and with our valuation based on this valuation model. During the class, I'll be using a template that I prepared for this class. This template is available in our LMS system, and later in your assignment, you can use the same template, and you can build everything you need based on this template. Or you can use your own template or start from scratch, but don't forget that if you use some outside template for your home assignment, then you should reference this template. You should refer to the initial source. You should always mention everything that you used in your work. And I actually don't recommend use outside templates for your work. Try to build your model from scratch, or at least use the model maximum. So use the model that I provided. Okay, so the company that will be working today is, one second, I'll start screen sharing. This company is Interroll. And Interroll is an interesting company because during last 2 or 3 years, all analysts always gave their expected fair price for its shares at the level about 6 to 8, I would say even 7 to 8. Sometimes it was before the pandemic. It was 7 to 9 rubles per share, but the company was quite stable at underperforming as compared to the analysts' forecast. And this is an interesting case where we can see that even if you have a good forecast based on your fundamental predicted parameters for this business, sometimes market just doesn't agree with you. And in this case, market didn't agree with virtually all analysts who predicted higher prices for Interroll. During the last year, its price was at the level about 5 most time. Although if we look at 5 years history, we can see that this company provides quite decent growth in its shares, but this is the past, and we are interested now in what value we would put into its shares today. So before you start working with any company like this, before you start building your own financial model and your forecast, the first step you always do is to go to a source of information that you'll be using. And this source of information, in most cases, is investor relations website of this company. On this investor relations website, you'll start with looking for 2 types of information. First, if you have something like this, investor data book, this is the first source of information for you, because this data book is an Excel file with all numbers about this company, all information that you can use in your financial model. And of course, copying something from an Excel file in most cases is more convenient than working with PDFs and other sources like these other text sources of information. So the first step is to download and keep with your model, keep with your records about your model, this data book. The second step even if you downloaded the data book, is to download and collect financial statements. In our case, it's just annual financial statements. Sometimes you can build a more complex model with quarterly data, but this is not that important, not that necessary for the model like this. And for our model, we'll be using just annual information. So the next step is to collect all annual financial statements for this company, usually for the last 3 years. So it's 2020, 2019, 2018. Because we'll try using just this data book, just this Excel file, but sometimes we need additional explanations, or we just need to check if this data book is actually correct. Data books are not always correct. Sometimes they have errors, and you can check this information with the financial statements. For the financial statements, we can suppose that they are always correct. Okay, so the next step is to collect all financial statements of the company. After you collected financial statements and data book, if it's available, the next step is to check if the market information about this company is reliable enough. And to see that, we should find information about the company's shares. Here we have two important things. First, we can see that free float for this company is 34%. So it's good enough. That means that this is a pretty liquid company, and we of course we can check the volume of trade for this company, but with this free float, and if we check that this company has enough as trade volume, daily trade volume, we can regard this as a liquid company, and its market price means something actually. So it's actual market price based on actual trade, and this trade is enough for us to believe in this market price. The next step, and one more thing here is, just because in financial reports or in annual reports, sometimes it's hard to find this number. So in the shareholders section of investor relations website, this information is often more clear and simple to find. So this is the number of common shares for this company. And again, one thing you should check for most companies is what the capital of this company is, because sometimes it's just common shares like here, but sometimes it can be several groups of shares with different voting rights, and sometimes with different par price, and so on. So you should be careful about these types of shares. Plus, some companies use like American Depository Receipts, Global Depository Receipts, GDR, ADR, and you should check what price you actually working with GDR price or with a share price, because one share isn't always equal to one GDR, like with Magnit, for example. But this is a very simple company in this area, they have just common shares, so it will make our model simpler in this part. The next step, before you start building a financial model, you should check what information we have about debt of this company. And with debt of Interral, we'll actually be having some problems, because I downloaded their presentation on that. So here I can close all that and go to this presentation. And what we can see about the debt. So they have some loans and borrowings. They actually have also lease, outstanding lease, and they didn't mention it here, but they have lease. We will see that in their financial reports. 1 second, I'll explain you about SecGov. Okay. But what we see here is that, in fact, this company doesn't have net debt. Their net debt by the end of 2020 is minus 233 million rubles. So they don't use debt at all. And that this fact will actually pose a problem for us, because in our valuation, we'll have to decide what capital structure we use for our valuation, for our calculations. We have a choice. We can either use their current capital structure and to value this company as is, as they use their capital now, or we can use something like industry average capital structure and value the company with this industry average capital structure. So that here is a kind of problem. And about your question, no, Russia doesn't have the same source as sec.gov for the United States. So we don't use sources like 10K reports and things like this. There are some websites where all public companies publish their official financial statements, but they're not standardized as much as for the United States companies. So I would recommend for Russian companies use their investor relations websites. Okay, and actually, for the United States, for American companies, I would recommend use an investor relations website as well, because if you ever visited those financial reports on SecGov, and if you try to walk in with 10K report, you could see that they are not well formatted. They actually they're quite ready to use them via some robots. If you go into fetch information from SecGov website automatically with some Python code or with something like this, you can do that. You can create automation for this analysis. But if you need information just for you, if you're going to work with this data manually, then on average, public companies provide better sources of information, and they're just easier to work with. Although there are exceptions, and actually for today, I planned Interrow. I used Interrow last year, and usually I change companies from year to year. This year, I planned to use Cemex. It's cement holding in the United States and Mexico. And when I downloaded all their financial reports, I found out that both their official reports and their reports and data on the investor relations website is so noisy, I would say. They so overloaded with some I don't know, presentations of operational data mixed with financial data and so on. So it would take just too much time to discuss it, or for me to prepare all the data. So just to process this data, it would take too much time from myself and then from you to understand what's going on. And I decided to stay with Interrow, just to updated their financial statements. And then also Interrow actually kept the same issue with big difference between their current market price and the market price recommended by analysts. Okay, so we've seen that there's an issue with debt structure, with capital structure, and with amount of debt used by the company. So we'll have to do something with this later. Okay, but now let's look at our model. And the first thing we will do for this model is we create a worksheet for the current price for its shares. So for today, May 25, their share price was $4.99, although it's again it was 50 15 minutes ago, but now it's again $4.99. So our model is up to date again. The number of shares is 5.4 billion shares, or 504,000 billion for 400 million shares. And that means that their current market capitalization is about 521 billion rubles. And here I copied their share prices for the last year. Okay, this is the first thing we do, just to prepare information about current position from which we start our model. The next thing we need is our discount rate. And here I collected some links. This is the correct link. Let's do. I collected some links for this valuation. And let's think about our parameters. So risk-free rate in dollars. We can see our risk-free rate in treasury bonds. Let's check what's today we have for treasury bonds. We need 10 years forecast, and That's it. Correct? Yes. It's 161. Okay, let's put it here. 161. Country risk premium. For country risk premium and for inflation premium, we had a discussion in our first lecture, right? What do you think? What numbers we put here? What would you put as our country risk premium? I'm waiting for your opinion. Okay, this is the principle we use. And the number we have here is country risk premium. We discussed that. 2.2. Okay. So it's 2.2 here. Okay, inflation premium for Russia. What would you put as our inflation premium? It was, by the way, it wasn't our first lecture, it was lecture 2, right? Maybe somebody remembers the numbers. $1.9. Okay, 1.9 with dollar forecast 2.1 and ruble forecast 4%. Okay, let's make it 1.9. Although this ruble forecast, we can put it at higher rate. Current inflation forecast. This is a long-term target of Bank of Russia, and they actually struggling now to they get the inflation 4%. But why not? Let's make it now 1.9 for beginning. Okay, for equity risk premium, as we discussed before, there are different approaches that can give us different equity risk premiums, but basically number like 6% would be okay for us. Okay, so 6% is our equity risk premium. The last thing is beta. Let's take betas from Damodaran, from industry. We will not calculate beta based on history of the shares of this company. Instead, we go into the years industry betas, and industry beta for energy. Oh, why I don't see energy here? Coal, energy. Okay, we have two types: green and renewable energy, coal and related. For interval, it would be gas, basically. But I think it's like coal and related energy. Related here, it's other fuel like this. So beta here is 0.83. For now, let's use this beta without any change. We'll discuss that later. Okay, and that gives us return on equity, required return on equity, 10.3. How we get this 10.3? We start with B3 with risk-free rate. We go to rubles and get with inflation premium, we get risk-free rate for rubles. Then we take our equity risk premium plus country risk premium. So that gives us like equity risk premium for our country. And we use multiple beta. So that's how we calculated this 10.3. You wrote something, yes. This is levered beta. Exactly, and this is the question you had to ask, because for our company, we have quite unusual leverage. Look, debt to equity ratio for companies in energy, in coal and related energy, was 95%. So it's about equal amount of debt and equity. And for our company, it's zero or even a negative number because we have negative net debt. But we'll discuss that later. Effective tax rate. This is very interesting. You can see 0 here. In Russia, tax rate is 20% corporate tax. Should we use 20% or industry average 0 from the Madaran? This is a very simple question. Let's look at their financial reports. Let's check what is the effective tax rate for this company. So their income statement. In the income statement, we can see income for the period. It's 75 billion rubles. Now their tax, we actually don't see. Where is the tax? Income. I can't even find their tax. In there, we can look at their. We can look at their data book, and in their data book, we will see an item, a tax item. Unfortunately, they made quite unusual thing. They created data book in Russian. The thing that people usually don't do. But we can see here, this is the income statement, this is revenue, and somewhere here, yes, this is the income tax. And we can see that profit before tax is 92, it's tax maybe in, sorry, I just lost the line here. Here, income before tax, it's 96, tax is 21, here it's 103, and the income tax is about 22. So basically they pay 20% as the tax rate, right? So for our tax rate here and later in the model, we can use 20% tax rate. For their cost of debt, later we'll see their cost of debt calculated from their financial statements. It will look very strange, and that's because they have negative net debt. So they have pretty random numbers in their interest expense and debt. I don't know why, but I just don't think that's very relevant to the task we have, because they don't have enough debt to make us work with their debt. But I think that for a company like this, cost of debt will be about maybe 7 to 8%. Let's make it 8% here, just to have everything prepared for our future calculations. And now, for our target share of debt, let's do it now exactly as Damodaran presented it about the industry. So if for the industry, share of debt is about 45% or even higher, right? Even higher, it's 94. It's about 49%. So with share of debt 49%, we'll see what we get with the evaluation. So what we get if we believe that they can change their debt to equity ratio. Okay, and weighted average cost of capital is calculated, of course, with the formula based on share of debt times cost of debt times 1 minus tax rate and plus share of equity times cost of equity. So now we have two discount rates. The first one is for free cash flow to equity, and the second one is for free cash flow to the firm. Okay, that's done. And now the main part of our model. And here you will see how most models like this are built. So the first part is to create a forecast for their financial statements. We build usually for valuation of a mature company with financial history, where we can use their historical records to forecast their future performance. We use 3 last years as a basis for our forecast. And here I'll build a simplified model. I will not try to model everything about this company. I will just forecast the key indicators, the key financial results for this company. And my forecast will be based on 2 things. The first thing, 1 second, I'll draw that. So the first thing for me is to create a forecast for the size of their business. And the approach to build this forecast will be very simple. They have sales, they have historical records on their revenue, and I will forecast their future revenues based on their revenue for this year and some growth rate. So this is the first step for me. And the second step, okay, how to convert this expected revenue into expected profit of the firm. The first step for me will be to build their EBITDA margin. So I believe that EBITDA margin is something that they earn from their operating activities. So I will use forecasted EBITDA margin to calculate EBITDA from sales. But in addition to their operating activities, they have some other elements of their cash flow. What elements? In their income statement, after EBITDA, they have depreciation, they have interest expense, and that's all. I'm not very interested in their depreciation. The only reason why I need their depreciation is to calculate expected income tax. But I'm interested in their interest expense. This is actually a cash outflow for this company. This is something that the company pays. So I will model, in addition to their operating activities, I will model what they have as their debt and what interest expense they bear because of this debt. And from this, I could calculate their cash flows. But to calculate their cash flows, I need two more things. First, I excluded from my calculations their depreciation. Yes, that's correct. But I should take into account their capital expenditure, because depreciation isn't a cash flow. I ignore it, but capital expenditure is a cash flow. This is something that company pays. So as one of additional lines here, I have my forecast for their capital expenditure. And for now, I have no idea what the capital expenditure is, and later we'll discuss it. And the last thing, the last line that creates difference between the operating expenses plus capital expenditure and the cash flow, the cash flow for the firm, is the change. Oh, sorry. The change in net working capital. And to calculate change in net working capital, I'll have to use the expected net working capital turnover. And by this net working capital turnover, I will calculate net working capital they will use in each year of my model based on the expected revenue for this company. So this is the idea of how I model their business. Yes, some companies have, I'll read the question. Some companies have large stock-based compensation, since it's not a cash expense. It is correct to adjust EBITDA by stock-based compensation. Yes, that's correct. And actually, let's look at their, again, the data book is in English, and it's too hard to find all this information in their financial reports. But in the financial statement, I will translate this for you. In their financial statements, they have a line, not a line, a worksheet with corrected adjusted EBITDA. And in their adjusted EBITDA, they actually, they actually have information about all non-financial adjustments to their EBITDA. Unfortunately, for those who cannot read Russian text, we cannot discuss this financial report. But yes, that's available. And the more complex is business, the more complex is equity structure for a company, the harder it would be to work with our model, because we will have to add more and more adjustments. And that's why we use this company, because it's just one of the simplest examples for our financial modeling. But yes, here actually, okay, to be fair, we need this adjusted EBITDA. With like cash EBITDA after all necessary adjustments. Okay, so for this company, this is the history we have about their revenue. They grew by 7% in 2009. In 2010, it fell by 4%. Do you believe that they will continue falling, or they will grow the next year, or maybe they will be stable and we should put 0 here? What do you think? Based on what you've seen in this dynamics, and based on the fact that you know that this is an energy company, and energy companies actually their revenues are pretty linked to a general economy forecast, because demand for their service related to the growth of the economy. So what do you think we should put here as their growth rate? Of course, yes. So we ignore this -4%, and as our growth rate, we can put something starting from 4%. 4% is inflation for us. So 4% means that we don't expect any real growth for this company. And I'll offer to start with this 4%. So no real growth, just inflation. The inflation we put in our inflation forecast in our calculations for the discount rate. And I'll make it this way. So in the future, if I need to change my forecast, I can just change the first cell and all the others will be changed immediately. Okay, so now we have no real growth for this company, and just inflation and growth. For EBITDA margin, again, we have a choice. We have 3 EBITDA margins for 3 years. They're quite stable. And in this case, I would offer to use just average of the 3 margins. When we model a company like this, that means that we're not going to analyze their business in depth. We're not going to analyze it maybe, and for many companies, that's the fact. Maybe this company will change structure of its business, will introduce new products, or remove some products, and so on. But this is quite a simple company. This is like just a network of power plants, and we don't expect that they will change this situation a lot. So we just expect that this business will work the same way it worked all the last years. Okay, so with that, we have now expected EBITDA for each year of our model. Now, depreciation. We have depreciation for 3 last years. Their capital expenditure for 3 last years, and their property, plant, and equipment from their balance sheet, fixed assets from their balance sheet. Now we do 2 things. First, let's calculate average depreciation period from their history. This depreciation period is simply what we had at the beginning of the year and what we accrued as depreciation for this year. And you can see that on average, their depreciation is equal to 11.5, 11.3, something like this. We can again use average from these 2 numbers and use this number for all our model. So now we have depreciation, and with this depreciation you can see that starting from this 358, we go in slowly to lower value of their fixed assets, and you can guess that the company cannot work like this. If they needed 358 billion rubles in their fixed assets, then probably after 10 years, if they have like 143, that means that their equipment is too old. They cannot actually operate with this level of equipment, right? So we believe that this value, this level of fixed assets is necessary for them to have this 1 billion of revenue, because they don't use I don't know, some innovations. They don't sell software or something like this. They produce electricity, and to produce electricity you need power plants, you need all the equipment you have, and so on. So at least you will have to stay at the same level of your investments. And how we can calculate necessary capital expenditure? The minimum level of capital expenditure we need is actually just our depreciation. So if in this year we depreciated 31 billion of equipment, we will have at least to replace it with new equipment, right? So this is the minimum level of capital expenditure we can expect for this company. But actually, we should expect that our investments will be higher than this number, because with this 31 billion of investments, after 10 years, we still have 360 billion rubles as our equipment, as our plant. But our revenue is now about 1.5 times higher. Why? We didn't plan any real growth, but inflation. We have inflation. So this 1.5 trillion rubles is basically the same as 1 trillion rubles here. And that means that our equipment probably should grow the same way. So it's not enough to have this 31 billion of annual investments in our fixed assets. We need some high level. I will not. Will not calculate it. We could calculate it with our inflation rate. Actually, let's do it. But you should remember that this is not the main way to calculate your necessary investments. So with inflation rate, we can calculate it this way. Our depreciation, because we should replace the older equipment, plus initial equipment times our inflation. So we need like 45 billions of investments. And by the end of this period, you'll have 530 billion as your fixed assets. And this is in real terms, in real price, that will be the same as our initial 358. And we can see that if we set our inflation rate to 0, then our property, plant, and equipment will be the same. But now we have inflation. So with inflation, we have these investments. Now, their debt and their interest. And with that, we have a problem because we know that their net debt is negative. Okay, that's true. Their net debt is negative, but they still pay something as their interest expense. Let's check it. This is their income statement, and they have financial expenses. Finance expense. Those finance expense come from two sources. First is simply debt, loans, and borrowings. They have very little non-current, have some current. And other part, much bigger, is long-term lease liabilities. Because if they presented their lease liabilities on their balance sheet, that means that interest expense from these lease liabilities will appear as finance expense. The problem for us is here that if we put the interest expense, or what they call finance expense, then we put the total debt, and total debt here, I calculated it manually. I sum up all the lease obligations and loans, and calculate then effective interest rate, which is interest expense over debt outstanding. We'll get some strange numbers because, of course, I don't believe in 21% here and even 11% here. So for some companies, not for this company, for some companies, you can use effective interest rate for your future forecast. But here, no, I don't think so. I think that this information from financial statements is somehow misleading. So instead of these numbers, I will put those 8% I used in discount rate calculation. So let's make it 8% as well. And we have a line, net change in borrowings. Because they don't have any debt, any net debt outstanding now, but when we discussed their possible WACC, possible weighted average cost of capital, we took information from their industry peers, and their industry peers actually used that. So if they use that, that means that we can use some debt here for this company to make its debt to equity ratio closer to industry peers. But for now, let's leave it blank. So their current debt for each year is equal to what we had last year plus net debt, net change in borrowings. So now their net debt or their total debt is the same as before. Okay. Next, profit before tax. This profit before tax, and actually, it's incorrect, right? For these years, that's incorrect because we had to use. This is something I lost when we just seen it. For 20, it was 96 to 1. 96 to 1. Here it's income before tax 103. And we can check it from here. I prepared it here, but then I lost the number. Okay, 92. 92. Correct? Yeah. Okay, but it doesn't change anything for us because we calculate this. This is just for comparison. We calculate our profit before tax based on our EBITDA. Let's look at this. EBITDA minus depreciation minus interest paid. And now effective tax rate, we can just put it as standard tax rate for this company, for all companies in Russia. So it's 20%. Okay, this is information about the net working capital. And after that, we will calculate necessary net working capital for this company by this formula. Revenue over 365 days in a year times how many days of outstanding net working capital we use for this company. And you can see 3 different numbers here: 69, 90, 115. What do you think? What should we pay, or what should we put, or what would be the most convenient number for us to put it here as their net working capital turnover? Do you have any idea? Okay, the simplest number would be the last number. Why? Because with the last number, change in net working capital here, and of course, we will repeat the same number. So change in net working capital here will be related only to expected growth of this company. So why we have this 12 billion rubles change in net working capital? Because our revenue grew from 986 to 1 trillion. And that makes our model simpler. If we put something like average number or even 69 days from 2018, what we'll have? Let's check it with this 69 days. So we have 100 16 billion rubles cash inflow in the next year, in the first year of our forecast, which is actually current year. Why that? Because if we expect that this company can work with 70 days of net working capital, then this year they will probably have from change in net working capital 116 billion rubles. And basically, we can do that even, and we have even some explanation for that. Look in their financial statements. Look at their current assets. What do you think about these numbers of cash and cash equivalents? They have they had 100 billion in cash in 2019. Now in 2020, they have even 180 billion in cash. So they have huge cash reserve. Look at their revenue. Their annual revenue is about 1 trillion rubles. What if we check for how much they have, for how many days of work they have reserved? If they have 180 over their revenue and times 305, so they have cash reserve for more than 2 months of operations, and that looks like absolutely unnecessary cash reserve. I don't know, I didn't check why they hold this amount of cash. Maybe for some acquisitions, maybe for some other reason, but they have excessive cash, and we could actually put something like 50 here, and that would mean that we believe that they will repay, or they will yes, repay to their shareholders all their cash outstanding, but that will be quite a bold forecast. We should analyze the situation. We should analyze why they hold this cash. So to make it more, I don't know, non-conflicting, to make it simpler to explain our model, we can start with the last year, so we don't plan any change in their financial, in their net working capital turnover, and we will not create any cash flow out of their net working capital. But this is our reserve. This is something that we can use in the future, actually. Okay, so with that, we created their change in net working capital, which is just change from one calculated net working capital to another. This is a part of our cash flows. Now we're ready, and that's all. We don't model all 3 financial statements for this company. We could do that, and in some cases we do that, and we can, in some cases, we can forecast revenue not based on just history and growth rate. We could calculate expected sales based on amount of products, prices for products, and so on. But for companies like that, for big, mature, stable companies, in most cases, that's enough. Now we can calculate expected cash flows for this company. To calculate free cash flow to the firm, first, we calculate earnings before interest and tax, but after tax. The formula for that is just our EBITDA minus depreciation and minus tax rate. Why we put depreciation here? To calculate income tax, expected income tax correctly. The next step is to put depreciation back to our cash flows. We subtracted depreciation here, but no, that's a cash flow. This is not the income statement. So we should put depreciation back after we calculated our tax correctly. Next step, change in net working capital. If we have higher net working capital the next year, that means that we paid something. We invested something in this net working capital. So positive change in net working capital creates negative cash flow for us. And the capital expenditure that we forecasted here, we added to our cash flow, subtracted from our cash flow, and that gives us free cash flow to the firm. Okay, now we have free cash flow to the firm forecasted for 10 years for this company, and we're ready to go to our first valuation. This is free cash flow to the firm, not to equity. That means that for this free cash flow, we will use as discount rate weighted average cost of capital. So it's equal to weighted average cost of capital calculated on the previous worksheet. Now, mathematics of our discounting looks like this. We calculate discount factor. This discount factor for each next year is equal to the discount factor of the previous year over 1 plus discount rate. So we calculated this discount factor. Now, this is our free cash flow to the firm. This is our discounted free cash flow to the firm. It's just FCFF times discount index. And the sum of these numbers would give us NPV, net present value, of these 10 years. But after 10 years, this company can still work because we invested enough. Each year we invested in replacement of old equipment. So by the end of this period, this company is still with all necessary equipment, all necessary plants, and that means that they can continue. They can continue working forever. And because of that, we do the last step. We calculate our terminal value, and our terminal value is based on, let's look at that, our free cash flow to the firm times 1 plus long-term growth rate. This is just our golden growth model, right? Over discount rate minus growth rate, and times discount index for the last year, because without this part, with just a golden growth model, we would calculate terminal value here in the year 10, but we need to calculate the value for now. So we should discount this calculated value by this index. And now the enterprise value is just the sum of everything we got for these 10 years plus the terminal value. And by the way, look at these numbers. You can see that about a half of the value of this company comes from the terminal value. This is a very important thing. That means that the next 10 years of its future actually defines, even now, later it will be much different. Even now, the next 10 years defines only half of its value. And that shows us that it's very important to understand a very long-term future of this company. Because if something happens after 10 years, that means that this company can lose half of its value. Actually, not half, actually more. Because now we have long-term growth rate. And for long-term growth rate, we have a question. What should we put as the long-term growth rate? We used for first 10 years, we used our 4%. That means just inflation without real growth. Okay, just inflation without real growth. And even with that, we now see that 2/3 of the company's value comes from the terminal value. And we have now enterprise value about 1.2 billion rubles. Now we have a choice. We decided not to change net working capital here, right? If we changed it to something like this, or it was 50, right? About 50 days. With 50 days, we would expect that the company will stop using so much money as their debt, and repay this money to its shareholders. If we believe in this, we should not put negative net debt here, because with negative net debt here, we would add this excessive money directly to our enterprise value, and we could not put both negative debt here and negative numbers here. We would count this excessive cash twice. But while we had 115 here, so we did not expect any change in net working capital that brings the question about net debt back to us. So what's the net debt of this company? They told something about, I closed it. They told something about 225 billion rubles. But let's look at their financial statements. Maybe we will miss something, and we should look at their notes. But let's take, for now, let's take just numbers from their financial statements. Here we have 181 plus some other current assets. They don't have current marketable securities. It's only here, and that's not. So I don't see actually the source of this 225 billion rubles. So let's just take this 181, and with 181 as the cash and 95 as the debt, we have like minus 90 billion rubles as net debt. This is a rough number, but let's take it at this level. The error will not be that big. Okay, so enterprise value is 1.2 trillion. Equity value is equal to enterprise value minus net debt. In this case, it's plus 90. So we got some comments. yes, we should account for cash, and this is the way we account for cash. What's net debt? Net debt is actually equal. It's equal to debt minus cash, right? And our formula here, this formula for equity value, if we put it this way, so it's equal to enterprise value minus net debt. That actually means enterprise value minus debt plus cash. So you can actually use this idea of equity value and relationship between enterprise value and equity value. But in valuation, people prefer using the term net debt. So in our model, in our calculations, we use net debt. Of course, for most companies, net debt is a positive number. This is just for Interroll. Okay, so now we calculated equity value. Here we have a copy of our number of shares outstanding. And now we can calculate price per share just by dividing the equity value by the number of shares. And we got now something like 13 rubles. And you can check the price again, it's 5. Why? Do you understand why we got such a high number? That's because we used WACC and because we used share of debt for this WACC based on target share of debt, not on actual share of debt. But that's just they don't have this structure, this capital structure. That they would have this amount if they wouldn't have this amount if they had enough debt. And at least we can change one number here. Imagine that with their this enterprise value, they have net debt based on the number we put in their discount rate calculation. That would mean that their debt would be about the same as equity. So that would mean that they would replace something like 600 here. 600 by their net debt. But the problem that they don't have this 600 as net debt. So it wouldn't be fair, this type of calculation. With this amount, we should put something like net change in borrowing. Here we get this additional 600, and then we should put 50 here, and we'll get something like this, about 9 rubles. Okay, so this is the first take on the evaluation. Now we'll make a break, and after the break, we'll build another part, we'll analyze another part of our valuation model. We'll use free cash flow to equity, and we'll discuss again all the numbers we put here for our valuation, and we'll try to find the optimal number that would create for us a model that we can believe in. Okay, now I just returned our numbers here, minus 90 here, correct, right? Okay, so now let's make a break. Let's make it until 8:05. Okay, it will be 11 minutes. I think it's enough for open line format. Okay, let's return to our model. So we calculated our free cash flow to the firm and then calculated value based on FCFF. Another way to do that is the free cash flow to equity. And free cash flow to equity, how we calculate free cash flow to equity? Let's look at that. First line is free cash flow to the firm minus what we paid as interest expense, because with free cash flow to equity, we consider all payments to the bank or from the bank as just as outside cash flow, just as revenue or costs and so on. So we add our interest expense to our cash flow, but we use here 1 minus tax rate, because with this interest expense, we will change the tax rate, and plus net change in borrowings, again, because if we have some cash inflow from a bank, this cash inflow is the cash that the shareholders can use to either reduce their investments or to repay this cash flow to them. Because sometimes companies use these borrowings, new borrowings, to replace some shared capital with debt. And for this company, for Interroll, that would be one of the possible ways to operate, to replace, slowly replace or quickly replace some shareholders' capital with debt, and that will be our positive free cash flow for equity. Okay, so we calculate free cash flow to equity this way. This is our free cash flow to equity. And then we do the same steps as with discounting of FCFF. So the first step, repeat our discount rate here. Now it's FCFE, so now it's required return for equity from our discount rate calculations. Okay, it's required return for equity, and then we calculate discount factor for each year and discounted free cash flow. This is an error. Now it's FCFE, discounted FCFE. Discounted FCFE, and after 10 years, again, we have terminal value based on long-term growth rate, free cash flow for the last year, and we multiply that by discount index for the last year to move it from the last period to the first period of this 10 years interval. For the long-term growth rate, we should use the same long-term growth rate as for FCFF. Now we got 400 here, and the equity value here is the sum of this discounted free cash flow plus discounted terminal value. Now the number of shares, of course, the same, and price per share is like this. And here you don't see net debt, right? Why? Because we accounted for net debt, for all debt inflow or debt payments or debt outflow, for everything that happens to debt in our cash flow. Within this cash flow, we used all information about the debt. So we don't subtract net debt here, we just got equity value. And price per share in this case is 7.5 rubles. And what do you think? Why we see this difference between price per share here and here? This difference is because our calculation for WACC. Yes, because of the discount rate, because we believe that this company will have target share of debt of about 50%, but the company doesn't have any debt, right? And if we put 0 here, we still have some difference. This difference is because of this net debt and because of something that we still have here, because we still actually we have some debt in our calculations. So if we believe that the company doesn't have any debt, we'll get exactly the same numbers. And now a big question. Okay, we understand that these two approaches give us different numbers because we had different expectations. The first one was, the idea of using FCFF was, let's ignore current capital structure. We believe that companies like this have optimal capital structure, and this company in the future, maybe in very near future, will change or can change its capital structure to this optimal capital structure. If that's true, if this company can get 50% of debt, then what it means? It means that the company will do something like this. Will change net working capital turnover to 50. That will reduce our debt structure to something like 600, or no, not 600. Yes, 600 here, and net borrowings would be 600 here. It's not exactly fair because this number puts 600 in 2020 actually, and we put it in 2021, but it won't change our calculations. So we'll get something like this. Yes, and you will see that the numbers will be much closer to each other. It's 9 to 10.8. Why they don't equal to each other? Because it's still a bit rough way to calculate the capital structure, and the basic idea is still the following. If you decided to ignore the current capital structure of a company, then you should put expected numbers in your weighted average cost of capital, and you'll get, oh, well, let's have it. And you'll get something like this as your valuation. And FCFF is the best choice when you decided to ignore the structure of capital and use some average capital structure instead. But if you believe that for some reason, yes, this way, that for some reason, this company actually cannot change its capital structure. And the reason why, what do you think? Why Interral maybe cannot change its capital structure and cannot set capital structure that we see here? Why do you think this? It can be our choice. And this zero share of debt isn't just current state of the business, but the future state. The reason I see in this is very simple. These betas. You have some answer? Okay. Yes, this is not a government company, a state company, but this is Russian company with their own. They not completely state-owned, but they have their own situation on capital market, their own structure of capital, and the numbers here are calculated based on the United States companies, basically. So this is another country, another market, another situation. Many things are different. So it's better probably to use zero as target share of debt, right? With zero as target share of debt, we get something like between 9 and 7.5 rubles. Maybe it's better if we don't use some average capital structure. It's better to use FCFE instead of FCFF. So let's use FCFE. That gives us 7.5. Now we don't depend on WACC altogether. We just exclude it from our calculations. We can even hide this part to focus on our FCFE calculation. Okay, what else we should change? Yes, there are some market risks, and there are other reasons to avoid using debt for Interral. But what else should we change? Look at this discount rate. Look at this number, beta. We used beta from Damodaran, and that beta, this number, was leveraged beta. So we should change it to unlevered beta. Unlevered beta for this company is 0.49. 0.49. Okay. With 0.49, we got required return on equity 7.5. It looks absolutely wrong. It's too low. And let's look why it can be too low for us. Maybe our inflation expectations are too low. Or maybe country risk premium should be higher. But something should be changed, because if not, we get 13 as our price per share expectation, and that looks way too high. Maybe we should expect higher inflation premium, but you will see that it doesn't change anything for us. With inflation premium 3, that means our inflation expectations must be not 4%, but 5%. And we expected that our growth rate is based on inflation. So we're still at about the same level, 12. And that's the model. This is our expectations. This is what we get from the fact on what this company earns. And we have one open question. Why this company with this expected or forecasted price for share still have about 7 to 8, sorry, from 7 to 8, yes, from 7 to 8 as analyst valuation, and why it has just 5 as their current price. I don't know right now. Maybe long-term growth is important, because without long-term growth, even if we have this free cash flow in terminal value, we immediately get something like 7. Maybe some other reasons, but that brings forward a question on how we build our long-term financial forecast for the company. From this financial model, you can see that just building a model doesn't always explain the value of the company. So we'll stop at this state of our model now. And in the next lecture, we'll discuss all economical, industry, and other factors that influence our financial forecasts and that are so important for us to see how our expectations convert in the value of the company. So this model can help us to convert our financial projections, our expected cash flows into value. But the valuation process actually starts before that. The valuation process starts with these factors. For this model, the factors, the questions that we should answer to was first, growth rate that we expect. Do we believe that the growth rate will be like this? Second, EBITDA margin. Do we actually believe that this EBITDA margin will remain the same in the next, not just 10 years, but 50, 100 years? Do we believe that this company can work with this level of capital expenditure, or maybe it will have to pay more? What do we think about capital structure of this company? And this capital structure will have very close link to these parameters, to beta and to target share of that. And by the way, in this case, one of the key issues is this industry level beta. I wouldn't put industry beta 1.5 like Domodara. I believe that industry beta for energy companies will be about 1.8 or even 1.9, because as I saw it for Russian companies at least, profits of energy companies are very closely linked to the general state of economy. And if a company have profits closely linked to the economy, I would expect that the beta for this company would be about 1, maybe slightly less than 1, because we can see that in other countries, betas for energy companies are lower than 1, lower than for the market. And with this 0.9 beta, you will see that the price would be about the number we expected. So, yes, it was growth rate. Yeah. Next question is this capital structure, and the last question is new investments or just general level of necessary net working capital. And for a company like this one, I would expect that their net working capital should be stable. And by the way, not stable on the level of 515 days. I think that something like 50 or 60 days looks much more plausible. And that exactly gives us not zero, but smaller, closer to zero cash, because why they need so much cash? They can repay it. So these questions, the answers to these questions depend on what we believe about the general state of the company. And in the next lecture, we'll discuss this general understanding of business, and we'll discuss some cases of several companies and how those companies changed from what investors believed about their business to what they got in real life. That's all for today, and see you next Tuesday.
Sorry, could you please answer 2 questions before we leave?
Yes, okay.
Yeah, so I have 2 questions. So the first one is about the level of complexity of financial models that is expected from us during our group projects. So I'm asking this because, for example, today we just use maybe the simplest method of forecasting future values.
Yes.
We took historic averages and assume that this is the rate that will be true for the future periods, but it's not always the case because the business of the companies can change, so it's not applicable to any company. And is it okay, for example, if we would use the same approach during our group projects, or we should provide some deeper analysis?
Look, yeah, we don't need to. You don't need to provide deeper analysis, and the subject company chosen for this group project actually gives you some advice about which level of complexity you can use. Volkswagen is a very complex business. This is a very big and complex business. You definitely cannot go to a level of individual products and so on. Sometimes for businesses like that, analysts split them into maybe 2, 3, or 4 business departments, divisions, and model there separately. But I don't expect from you that you'll do that for Volkswagen. So your forecast will be based just on your general understanding of how bright is the future of Volkswagen, and how this expectation translates into growth rate, EBITDA margin, new investments, new capital raised for this growth, and so on. So it's okay to use complexity at the level we discussed for Interroll.
Okay, thank you. And the second question, could you please also comment on the last quiz that we had on relative valuation, where we had to compare Magnet and Dixie based on price multiples? Because the problem there is that Dixie got delisted in 2018, so it's there is no market cap available, and we just needed to use.
Well, wait. Dixie delisted, but Dixie bought.
Yeah, but it's like this price it is an enterprise value, yeah.
Wait a minute. One second. I'll open it. Okay. So oh, I asked you about price to sales, and it must be EV to sales, right?
Yeah. This is the
yes.
point.
It was my mistake. Usually, companies, when they declare acquisitions, they tell about equity, and I just missed the point that it was enterprise value, not equity price. So just if you didn't try the question, just answer the question based on the idea that 94 billion rubles is the equity, not debt. It's incorrect here, right?
Okay, thank you. Then I understand. Thank you.
Mm-hmm. Yes, I just missed it. It's unusual to write about enterprise value in the deal, because during the deal, the acquirer pays for equity, not for enterprise value. Okay, and then after that, everything will be okay with all calculations. Okay. Any other question? I just would like to remind you that this model, the model I used today, is available in LMS, so you can download it there and use it in your group project. And I actually expect to see your drafts maybe this week. I mean, not necessarily the draft for your free cash flow valuation, but your relative valuation for Volkswagen, your general expectations about the company, and so on, so that we can discuss it and correct something. Okay, that's it for today. Bye.